Well, the way that we go about thinking about our philosophy and how we pick the companies that we want to invest in is to very much take a long-term, fundamental, bottom-up driven approach. We are aware of the benchmark, but we do no more than pay notice to it. It doesn't colour the way that we think about constructing our portfolios. And we seek to identify 40 or 50 in round numbers, really high quality businesses. And by that I mean businesses that have very strong balance sheets. That's an absolute must-have. Because we want to be confident in the survivability of our investments over the long term, because we're making these decisions over a 3 to 5 year view, not a 6-month or a 12-month view. We want high quality and highly experienced management teams. We want business models that, in our view, have longevity, nothing that lasts forever, things have to evolve, but will have longevity, have a sustainable and distinct competitive advantage. And when we've identified these businesses, then we put our portfolios together. And if you were to talk to a lot of fund managers, they might talk to you about notions like, we think we might be facing a rising interest rate environment, so we have tilted the portfolio in this direction or that direction. Or we think that inflation may be going to stay lower for longer, and so we've done this with the portfolio. But that's not the kind of conversation that we have. Our views on inflation and interest rates and other macroeconomic factors go into our thinking about the specific company and the bottom-up fundamental analysis. But the features that you see in the portfolio are a function of how we've put the portfolio together and the companies that are in it, not the macro themes determining which companies we're going to have in the portfolio. And so if you look at where we're overweight and underweight, remembering what I've said about really only paying lip service to the benchmark, you see, for instance, that we're underweight oil and gas. But that has much more to do with the fact that oil and gas is such a massive sector in the benchmark. How can I say to you that we have a sensibly constructed, appropriately diversified portfolio, and then say we've got nearly 20% of it in oil and gas? It doesn't make sense. But we actually quite like some of the oil and gas companies, the likes of Shell. We've said for a long time that capex they have in the business will eventually start to earn returns, and that's quite an attractive proposition. So we quite like Shell, but we're underweight oil and gas. You have to be careful what you read into overweights and underweights in portfolio construction. We are overweight aerospace and defence. Quite a number of people look at us and say, but you've got a yield orientation. Well, yes, we have, but we also want to deliver growth in the income that the trust delivers, and we think there's some quite attractive dividend growth prospects in aerospace and defence, for instance. So we have a number of places where we, by definition, will be overweight and underweight the benchmark, where that is a function of what we like about the companies, not how we've tried to position ourselves relative to the benchmark.